All right, let's dive right into this explainer. Welcome to a masterclass where we're going to peel back the layers of the invisible matrix that literally surrounds us all, the economy. Today, we're revealing the mathematical and psychological rules that are secretly governing your everyday life. We're going to look at why you earn exactly what you earn, how money is literally typed into existence out of thin air, and the invisible forces making your everyday decisions for you. So let's start with the fundamental glitch of the universe. As human beings, our desires are absolutely infinite, right? You want amazing food, a premium house to live in, the latest flagship phone to show off, and basically everything your neighbor has. That's just human nature. But here is the core problem that no amount of technology can ever fully solve. Time, capital, and physical resources are strictly limited. The physical world operates under strict caps, so there simply isn't enough stuff for everyone to have mansions and unlimited wealth. And this brings us to the core concept of scarcity. Scarcity is the harsh reality and the main reason you just can't have everything. Think about it. If unlimited pizza and Wi-Fi existed and we all had endless zeros in our bank accounts, the entire subject of economics simply wouldn't exist. We'd all just be chilling. But because absolutely everything is finite, humans are forced to do something very difficult. We are forced to make choices. Let's bring this down to earth to see how it affects your daily life. Meet Ravi. He's a 22-year-old student, and he only has 3 hours free tonight. He's got two choices: binge a new web series with his friends or study for tomorrow's final exam. Now, if he chooses the series, the true price he pays isn't measured in currency. The true price is the exam marks he sacrifices forever. This is his opportunity cost. We often think prices are just about cash, but the true cost of literally any action you take is the exact value of the next best alternative you gave up. So how do we survive this world of scarcity? Well, we trade. Trade happens when two people possess complementary shortages and surpluses. Let's look at Amit, a corporate guy who runs a side business but has zero free time. Ravi, on the other hand, has amazing video editing skills but no money for rent. When they meet, magic happens. Ravi edits for Amit and Amit pays Ravi. But there's a deeper concept at play here called comparative advantage. Even if Amit was actually a faster video editor than Ravi, Amit would still outsource the work to him. Why? Because Amit's primary business makes him way more money. Trade is driven by who can do the task at the lowest opportunity cost. Outsourcing efficiency is literally what keeps complex economies functioning. All of this trading creates a market, organized by what Adam Smith famously called the invisible hand. Markets are invisible systems governed entirely by buyer and seller interactions, where price acts as a massive, blinking neon signal. Take onions, for example. Let's say continuous rain in Maharashtra destroys half the crop. Supply crashes, but people still desperately want onions, so the price rockets from 20 rupees to 100 rupees. Now, consumers get angry, right? But that 100 rupee price tag is actually a critical market signal. High prices incentivize producers. Farmers everywhere see this high profit margin and decide to plant only onions. The result? The market is flooded, supply overtakes demand, and prices crash back down to 10 rupees. It's an automatic system driven entirely by human desire and math. But hold on, markets were great until you hit a roadblock. Imagine Amit wants onions, but he has zero cash, only an extra laptop to trade. The onion seller doesn't want a laptop, he wants milk for his child. Bartering goods is just incredibly complicated and full of friction. So, to solve this massive headache, humanity came up with its greatest invention, and honestly, its greatest illusion: money. What's really wild is realizing that money has absolutely zero intrinsic physical value. Throughout history, it's been stones, shells, gold, paper, and now it's just digital numbers on a screen. The only thing they all have in common is collective trust and institutional credibility. If a central bank goes on TV tonight and declares a 500 rupee note invalid at midnight, it instantly becomes a worthless piece of scrap paper. Currency isn't actually real. It's pure belief acting as a standardized medium of exchange. And to manage this illusion, we built banks. But if you think a bank is just a safe locker where your cash sits, think again. Through a system called fractional reserve banking, modern banking systems literally generate money through credit creation. When Amit goes to the bank for a 1 lakh rupee car loan, the manager doesn't go to a vault and pull out cash. They literally just type some numbers on a keyboard and boom, new digital capital enters circulation. Banks loan out far more than they actually hold in reserves. Okay, moving on to the scoreboard illusion. Let's quickly deconstruct GDP and its fatal flaws. To track all this money and production, economists built the ultimate macroeconomic scoreboard, gross domestic product, or GDP. It measures the total monetary value of finished goods and services. But it has a massive blind spot. Meet Mina. She's a homemaker working from 6 a.m. to 11 p.m. as a chef, tutor, nurse, and financial planner for her family. Because she gets no formal salary, Standard Metrics value her 17 hours of grueling daily labor at absolute zero. Meanwhile, if Amit buys 500 rupees of junk food, or if a factory pollutes a river but turns a profit, GDP goes up. Macroeconomic metrics often measure sheer output volume, completely ignoring non-monetized domestic labor and the holistic economic health of a society. And speaking of hidden economic realities, while you're sleeping peacefully thinking your savings are safe, a silent thief is emptying your pockets. That thief is inflation. When central banks print too much currency and that money supply expands faster than real output, prices explode. Your purchasing power is quietly but viciously reduced. Let's look at former central bank governor Raghuram Rajan's famous dosa economics to really picture this. Say you put 100 rupees in the bank at a great 10% interest rate. After a year, you have 110 rupees. You feel richer, right? But wait, inflation was 12% that year. So your favorite masala dosa, which used to cost 100 rupees, now costs 112. You have more nominal currency in the bank, but you literally cannot afford the meal you could buy yesterday. Your real wealth eroded. Now, let's shift gears to the human reality, looking at behavioral economics and wealth gaps. The economic matrix isn't just about math. It's about actual humans. You ever wonder why a global CEO makes 300 times more money than a hardworking data entry employee like Amit? Does the CEO exert 300 times more physical effort? Absolutely not. In this system, your wage valuation has almost nothing to do with physical sweat. It's determined by one brutal metric: how insanely difficult you are to replace. There's a high supply of general labor for Amit's job, but a CEO possesses scarce, specialized leadership skills. You are paid based on your replacement difficulty. This harsh reality also impacts how we make choices, especially for those in poverty. Classic textbook economics assumes humans are highly rational, calculating machines. But Nobel laureates Abhijit Banerjee and Esther Duflo's research reveals the real-world poverty trap. Crushing biological stress and resource scarcity totally skew long-term decision-making. If a laborer finds an extra 500 rupees, their stressed brain demands immediate psychological relief, so they might buy a TV instead of logically investing it. They literally prioritize immediate relief over delayed investment. Honestly, though, it's not just the poor. We are all deeply irrational. We suffer from something called hyperbolic discounting. That just means a smaller reward today is vastly more appealing to us than a massive reward next year. Massive platforms actively exploit our human biases, like loss aversion, proving that a lot of the time, economics is actually just psychology disguised as numbers. To manage all these human flaws, desires, and scarcity, the world built different economic frameworks. Capitalism relies on private ownership and the profit incentive, which is great for high innovation, but runs a serious risk of wealth concentration. Socialism uses state allocation to aim for baseline equity, but historically it risks reduced efficiency. Then we have the mixed economy, like India, which blends both, fostering free market private enterprise while maintaining public oversight and social welfare structures. Every single system has its trade-offs. So what should you take away from all of this? Scarcity is universal, every single choice has an opportunity cost, and inflation absolutely never sleeps. But now that you've seen the matrix, you have to ask yourself, will you remain a pawn, or will you use these hidden rules to actually build your own wealth? If you found this explainer helpful today and you want us to do a deep dive into mastering the stock market next, make sure to show your support, because understanding the rules of the economy is the first step to mastering your life. Catch you next time.